If we see promoter holding declining or promoter selling in a big way, we see that as a red flag. So a company with a very high level of debt is something which we will avoid. We never thought that full delivery business would be generating cash, would be making profit.
Is there an absolute number when it comes to a stock's P beyond which you will be uncomfortable?
I think value trap are something where the growth visibility of a medium term is not there. We define companies which are at inflection point. It means that the capital allocation of the business are going to change. When we think businesses are at inflection point, that is the time when the investor makes the maximum earnings. The focus is towards growth because even the regulator has become pro. While I'm not supposed to tell the return because that is what SEBI doesn't permit anyone, but I'm just saying that
Hello everyone, welcome to this show, Portfolio Dialogue with the Fund Manager, and I have with me today Anand Laddha. Anand is an industry veteran with more than 2 decades of experience. He manages our HDFC Value Fund and HDFC Banking and Financial Services Fund. Hi Anand, welcome to the show.
hi Ram, thank you, and thank you to all our viewers.
Yeah. So let's set the context. Let's begin with our discussion with the HDFC Value Fund. And when it comes to the value investing concept, we all know India is a growth economy. We also got the tag of the fastest growing large economy tag also, which means that generally stocks trade at a premium. So in this context, as a manager of a value fund, first of all, how do you define value and how difficult is it to manage a value fund?
So Ram, everyone has a perception that value means buying businesses which are cheap or which are trading at below lower P multiple. That is not the true definition of value. We see value in a very relative terms. In our fund, we define value in three buckets. We see value as businesses, stocks, companies trading below intrinsic value, below replacement cost. We see another as a second bucket, we see businesses trading at relatively valuation. Either they are trading at relative discount to the sector or to the uh, broader market. And third, we define companies which are at inflection point. When we mean inflection point can be anything. It could be that the businesses are going to have an upward margin trajectory. It means that the capital allocation of the business are going to change. A large part of capex will become operational. Lot of which means that business are an inflection point, and from there on the cycle would begin. These are the three broad bucket when this is the way we manage value fund, and this is the way we look at value.
So generally, to continue with that question, Indian markets do trade at a premium. We have the officially the fastest growing large economy tag. So stocks do trade at a premium. So how do you go about, bucketing according the stocks according to three definitions, and how challenging is it to manage a value fund in the Indian context?
Ram, I don't think it is a challenge. See, our markets, to set context to this question, actually, if you look at our market from last 3, 4, 5 year period post COVID, we've seen a very strong bull market, mother of all bull market, you can say that, because this is the biggest bull market I've seen in my history. And then you think out what led to this bull market. It was largely driven by earning growth. We had very widespread across sector earning growth improvement that drove valuations and on those stock market multiples across all sector. Whether we call turnaround companies, we call relative valuation companies, everything done well, and it was only driven by valuation and earning growth. Post that, what has happened? Last 2 years, if you see, we are into a phase of consolidation. Okay, and why this consolidation? See this, because last 3 years before that, when we had a bull market, okay, earning growth were higher. Every company had seen higher margin. Second, all our Indian corporates have seen the asset quality cycle. Post that, everyone was focusing on cash flows, ROE, and optimization in terms of improving productivity. So we have a very high base, and last year we were consolidating. Or last 12 to 18 months we are consolidating. Consolidation was driven by earnings slowing down. Consolidation driven by large supply of paper. Consolidation driven by geopolitical issue. We have tariff issue, all that, and this is what led to forcing the government to look at internally. And we have seen a lot of measures the government has taken. So today, as we speak, we are into a phase where we said our markets are consolidated. While India is a growth market, but last 12 to 18 months, India has underperformed emerging market very significantly. And which is why today, as we speak, our valuations are becoming reasonable. And we are again entering into a phase where we are seeing earning upgrade cycle will start. And in that context, when I say value, we define value in three buckets. So for me to find value in a relative means has become very easy. Second, many sectors, stock companies which were high valued, high PE, all have corrected because of the growth slowing down.
Hmm. So, great. So, you mentioned about the earnings growth cycle probably coming back. And from the last 1 year perspective, we are at a much more comfortable position when it comes to overall market valuations. In the last many years, if you say last 15 years, there were market cycles wherein we've had typically the perceived so-called quality growth stocks doing well over a period of time. That was probably from 2014 to 18, 19. Then after COVID, the value cycle. This is the overall narrative that people have, that there is a cycle for growth stocks, there is a cycle for value stocks, and we've had the last 2 years the value story playing out very well. uh, do you see any such changes? Do you, first of all, subscribe to this overall belief? And do you see any such changes happening, any turnaround in the overall cycles in the next 2, 3 years?
So Ram, you rightly said we had a growth cycle followed with a value cycle, but I think the only point which everyone is missing is that even a value stock does very well only when the earning inflection happens.
Sure.
We have a very classic examples. Uh, uh, if you look at the two largest government-owned infra NBFCs, they were trading at 7-8% dividend yield or maybe 9% dividend yield. No one in the market was looking at it. They were trading at probably 0.4, 0.5 times book value. And today, as we speak, they had almost 4 times given returns. What has changed? I don't. The only thing which has changed is the earning.
Sure.
Today, as we speak, if you look at the public sector banks or public sector enterprises, they have all rallied very much. So, what has changed in them? The only change happened is the earning growth has been very strong. So, in that context, I think the key focus remains the earning growth. If I give you some example, last 4 5 years we have a new sector which has come, which is the EMS space, electronic. In that, I think if you look at the stocks which were trading at 100p multiple or 70 80, all have corrected. Why the correction? Just that the growth has slowed up. So in that context, if you see even the growth stock, if the growth slows down, get corrected very significantly. So I think we are entering into a phase where we think a time has come where we look at the GARP strategy, which we call it growth at reasonable price. And if you look at in a broader sense, the HDFC Value Fund follows a blend of a GARP strategy and looks at businesses which are inflection point. So if you look at my fund, I also have stocks which are high P multiple, which what do you mean by high is like a 40p multiple could be high P multiple. But these are the stocks companies which have corrected from 80p multiple to 40p multiple and now are available at a reasonable price in terms of what we call is GARP strategy, growth at reasonable valuation.
Hmm. So, I mean, you mentioned various things. It's been 2 years, I think, since you have taken over this value fund as a fund manager, and it's been amazing in terms of the performance versus the benchmark has been strong. And so, what's been your, I mean, I would say typically the hits and misses, right? So, the wins, major wins and major misses when it comes to your overall stock selection, sector selection. Stock specific stuff we'll not be able to cover from a compliance point of view, but you can broadly mention what has been your, I mean, wins when it comes to major sectoral overweights, underweights.
HDFC Value Fund is a very old fund of our house. It has more than a 15 years of track record. This fund has a long vintage. This fund has seen many fund management changes, and despite all that, the fund has delivered across all time period, which means across all time period, every fund manager who had looked at fund has given justice to fund in terms of the strategy they followed. And therefore, across time period, it has done well. Last 2 years, when I took over the fund, this fund was positioned well, and I did lot small changes to the fund. So in last two, if you ask what has changed in the fund, if you look at 2 year back, what were the number of stock in the fund, the names in the fund, today as we speak, 50% of the names have changed.
Sure.
Okay. And as I mentioned, I started looking at this fund in three categories.
Hmm.
intrinsic value, relative valuation, and turnaround business. So when I took over the fund, I added few defense stock to the fund. I added few BFSI stock to the fund. I added lot many other sectors which I believed were at inflection point. Maybe a hospital business, maybe some pharma company, and across the board. And in the last 2 years, all this inflection point businesses has delivered very well. There are few misses in those names also. So when we define inflection point businesses are such when we say that business will see turnaround. But overall, if you look at the tally of uh, strong performance has been a better, tally of the strong right selection has been better.
Great. So, so you mentioned about a few sector examples that you gave from a, but overall from a themes perspective. So today there are so many popular themes from an investment angle. Like there is a consumption theme or the auto, the defense, and various other themes, the pharma. So which one from a next 5 year perspective, where do you see value? Actually, from a value investor point of view, the idea is to think beyond what is popular, right? So that is a there is an element of contrarian thinking also that comes in
Correct.
when it comes to managing
So
value fund.
the last 5 years we have seen unprecedented bull market. We have seen unprecedented number of company coming for raising capital. So India, as we speak today, is a well discovered market.
Sure.
Okay, and if you see the amount of inflows the mutual fund get, which clearly means that the cult of equity investing has come. And thanks to Amphi, which started with the ad of mutual fund Sahi Hai, which also triggered a large scale of this. So in that
Our regulator SEBI has
also
got
had done a lot of
role
in
to
terms
play in
of
that.
investor education, streamlining the fund
Yeah, yeah.
structure, all that help in increasing the flow towards equities, increasing the flow, awareness about equity investing and the return it generates over time. So in that context, our market today are well discovered, and therefore GARB as a strategy would do very well. So my portfolio has both inflection point businesses, also growth businesses which are fit in a definition of GARB, which is growth at reasonable price. So if you look at some of the hospital businesses which we own, that is a theme which is a multi-year theme. As a country, we still has a shortfall, and this sector has seen both re-rating, new hospital bed addition, and are consolidating. So from that perspective, from a next 3 year or 5 year perspective, this is a sector we will see value emerging. We invested in BFSI spec. I believe BFSI is going to be an evergreen space. Lot more changes have happened at the regulatory level, and that benefit will remain for next 3 to 5 years. While India will be behind in tech, but in BFSI space, the regulator has been ahead across all world. We have JAM, we have UPI, those are significantly. So in that context, BFSI will remain an evergreen sector. There are other sectors. See, when government come out with the rationalization of GST, we thought staples could be one of the sector to be benefited. So far, it has been a non-starter. Uh, okay, this could be a big contra as well as a relative valuation theme. I think the whole staple pack should benefit. See, the GST benefit has gone, or we have seen the visibility in auto stock, but I think staple could be another sector where you'll see a lot of benefit to come. At this moment, as we speak, IT can be a big contra sector. Uh, Across the board, there is no clarity what sort of impact AI would have on Indian IT sector.
The overhang is still there, right?
Still there. So that's why I say it could be a big contra. So that's why I say a value fund would has a broader definition, it includes contra as well. So this can be a big contra sector. If the AI bubble or if the people feel that AI investment would not bring out the result as expected, it could benefit the Indian IT sector immensely.
Sure, that's interesting. Given the, I mean, I think I'm seeing your portfolio is like we are overweight on BFSI mainly, but are we taking weights on the IT stock?
We are not
this correction.
okay. So we are not overweight on IT as a sector, but we are very stock specific on the IT sector. So we have done a lot of bottom up in IT. We have done a lot of bottom in consumer staple as well.
Industry. From a market capitalization perspective, I'm sure that is a popular question among the viewers today also. I mean, the large cap versus mid cap, the small cap debate does come in any discussion. But from a value perspective, is there any kind of bias that you have or any overweight, underweight you consider? Is that a key factor also for you?
I think this fund when we run, we look at all bottom of idea.
Sure.
And we look two things we look very closely. One, a relative valuation, and we look at businesses which are or sector which are at inflection point. and in that context only we build portfolio. The outcome, more large cap or mid cap or small cap, is just an outcome. It is not a thought process. So you invest across sector. So the stock where the portfolio, which the lowest market cap company could be 1,000 crore market cap in the portfolio as well.
What about the newly listed businesses, especially a lot of new age businesses have been listed in the last, I think, 1.5 years. India has been one of the biggest IPO markets in the world in terms of the number of issuances and even the monies raised. Many of those listings, in terms of their business, is at their nascent stage of their earnings cycle. In many cases, the P/E ratio apparently does not make sense. There have been many issuances wherein there is a social media uproar also why mutual funds are investing. But in hindsight, many of them have actually made money also from a portfolio investment perspective. How do you look at them? Do they have a place in a value fund? Third, how long term do we have to look when it comes to these analyzing these businesses?
So Ram, we do look at all this company. We call these companies as challenger company.
Challengers.
Okay, these are the one who are coming out disrupting the existing businesses, or the new old age businesses, and are coming out new thought. A very good example could be a quick commerce company. Today, they are challenging the mites of old retailers, uh, which are doing. Uh, so these are challenger company. See, the only context we look in these companies, are they able to create a large market? When we, if they are able to create a large market, large turnover, profit will follow.
Sure.
Okay, and we are seeing that happening in food delivery. We never thought that food delivery business would be generating cash, would be making profit. Similarly, we are hopeful that the quick commerce would also become a profitable business at some point of time. They are already able to have a large top line. The largest food delivery quick commerce company turnover in is similar to what the largest listed uh, retail company now. It may be a matter of time it would have a higher turnover. So I think we are very open in terms of looking. See, when we look at all this company, we look at through a GARB lens. We are buying this company at what valuation? So the growth is coming at what valuation? And second, the HDFC value fund, how does it fit into value? Is because our value fund in our of a scheme information document has defined value as, we are buying 60% of the portfolio in the company will be such where the trailing price to book value or PE will be lower than the last 5-year price to book value or PE. If this company fits into that
The basic
definition,
filter is already in
yeah,
place. The universe itself
it's
is
defined, well defined.
defined.
So this is 60% of the portfolio, 40% of the portfolio could be anything. So if the company defines in this portfolio, and if it suits in our definition of business inflection point, relative valuation, it become part of the portfolio. So as we speak, I own some of the quick commerce company in the portfolio.
I'm looking at some of the audience questions as well. Couple of questions I would like to take. Is there an absolute number when it comes to a stock's P beyond which you will be uncomfortable rather? So I'm sure your universe filtration itself to some extent takes care of that thing. But many of the times, the not just newly listed companies, but in many cases, you said the turnaround businesses are there. Classic case wherein the PE ratios may not appear. But how do you distinguish between such cases and relative value in your own bucket? And in some cases, you may have to take a step in to buy slightly higher PU ratio businesses also. How do you deal with that?
So there are ways to look at businesses. If the, many a times we look at the business on the cash PE basis, while the business may have a high depreciation and therefore they are not generating profit. So in that context, we look at the cash PE. If they are generating enough cash flow, then you look at based on the cash flow they generate and you value them on cash PE basis. Some of the hospital stocks, when we talk about, they trade at 20-25 EV/EBITDA multiple. And in terms of P multiple, if you look at, they would be at 40-45 times
Sure.
EV/EBITDA. So you look at the cash flow generation from those hospital, and then you value those on cash flow basis. So that is one benchmark, because whenever you construct an hospital, it has a life of 15-20 years. So definitely depreciation in initial year will be very high. Second, how do you look at quick commerce companies? Okay, so see, these are the companies when they get listed. That time there was no business case for them. Today, as we speak, they have demonstrated substantial business case for them and are generating positive EBITDA.
Hmm.
So in that context, you look at how long the growth runway for them is available and how they are placed in terms of relative valuations. The largest retailer in the country, while I can't name it, it was trading at 100 p multiple,
Sure.
and today, as we speak, it's still at 70 p multiple, despite the fact that it has a retail outlet on that. In that context, if you look at the quick commerce company are trading at similar multiple with a higher growth and are generating cash flow.
Hmm. Sure. Okay, we discussed about high PE stocks. Let's discuss the other side as well. There are low PE stocks as well. So is there, I mean, is there any red flag or some aspects you look at that may disqualify a company irrespective of how cheap it may be trading? So what are the things that you'll say this is strict no, I'll not look at this company?
Generally, mutual funds are not active investors. When we say active investors, that means we don't participate in the board of the company. We remain a passive investor. We support the board and as well as the management.
Sure.
So specifically in cases of mid and small cap companies which are into high growth phases, if we see promoter holding declining or promoter selling in a big way, we see that as a red flag. We would like to have some promoter or we would like to have some founder being associated with the company so that who can run the business and take decision in favor of every shareholder. So declining promoter ownership or a lower promoter ownership is one sort of concern we have. Second, we look at the debt to EBITDA level. If a
Hmm.
company with a very high level of debt is something which
Hmm.
we will avoid investing.
Anything from a sectoral perspective that is could be termed as a value trap? This is from a stock perspective. From a sectoral perspective, things are looking cheap, but there is some structural weakness, or you are kind of avoiding those set of companies. Any themes, any at this point in time?
So, Ram, why a company or sector become a value trap? The only reason I see that is the medium term growth outlook on the company or on the sector is not good.
Hmm.
If that is the case, when it becomes a value trap. Few year back, PSU banks were in similar value trap situation. You can say that the growth was missing or asset quality, and as the earning reflection comes in, people follow it. So I think value trap are something where the growth visibility of a medium term is not there, and that's why we don't invest in companies where we don't see a growth visibility in the medium term. And in my discussion, I have been speaking more specifically on inflection point. So this is what we focus more. If what is the growth visibility from a medium term perspective? Near term, no one can predict, but over a medium term, which means a 2 to 5 year or 3 to 5 year predict business. If we have a 3 year view, positive view that the business is changing, we would look at it very closely.
Sure. So there are some questions. Uh, so how would you differentiate a value fund from a flexi cap or a multi cap or a large end? Because people want to know, because this is a category as defined by SEBI, which is not on a market capitalization basis, but from a style perspective. So, but however, most or every fund manager on the flexi cap who manages a flexi cap fund or a multi cap fund or a large and mid does have these style kind of criteria to choose businesses. So how do you differentiate such a fund from a market cap based defined fund?
You ask a very good question and very valid question. Today, from a financial advisor point of view, from a distributor point of view, and from an investor own point of view, there are multiple schemes in the market available: flexi cap, large mid cap, mid cap, small cap. How do why value should be a part of the portfolio? See, value fund like our HDFC value fund, our benchmark is CNX 500, which is similar to a benchmark of a flexi cap fund or to many more funds like that. In this fund, we specifically looks at a strategy wherein we look at relative valuation, and there's a clear cut definition. So because of the definition, we would be investing in companies which where multiple are lower than historical multiple. Also, we look at uh, business at inflection point. And in all my discussion, I've been highlighting this question quite some time that we look at business at inflection point, and you can compare the value fund portfolio with any of the portfolio in the industry, which are similar like flexi cap fund, large and mid cap. This portfolio is different. The overlap is not very high, and See, when we think businesses are the inflection point, that is the time when the investor makes the maximum earnings. That is the time where you see company earning growth improving as well as P re-rating happening. That is time you make maximum money. As we speak, this fund would have 25-30% allocation towards businesses which are inflection point. And therefore, we believe that this fund could give higher return over medium term point of view. While I'm not supposed to tell the return because that is what SEBI doesn't permit anyone. But I'm just saying ki generally examples of business at inflection point, you get higher return than businesses which are compounders. So this fund has a blend of both. This fund has a blend of GARP strategy. And in that context, this fund is a differentiated and more importantly, the index is widespread.
Hmm.
With the large index base, I have a large ample of selection available, which makes it that it's a must-have in a portfolio.
Great. Anand, you also manage the other fund, the HDFC Banking and Financial Services Fund, actively managed portfolio. Now, you have also been a banking and financial sector analyst for uh, 20 years now, nearly
Yeah, nearly 20 years.
nearly 20 years now. So how do you look at that portfolio? How do you go about when it comes to deciding overweight, underweight within that? So we have an index, and you have to choose weights for your name. So how do you go about? I mean, give us some sense whether it. I mean, between the private sector and the public sector, and how are you overweight, underweight at this point in time?
So Ram, the BFSI is a sectoral fund, and in general, sectoral fund generally run a very concentrated portfolio because of the fact that the index is also a little concentrated index. In that context, this all sectoral funds are good for investors who want an extra alpha or who are ready to take a higher risk. So it's a so whether it's a BFSI sector or any other sector fund, this should be
Yeah,
part of the portfolio
yeah,
because that is where if the sector or the cycle does very well, you make very high return in those sector. So the BFSI cycle last year has been very good, and you could see the BFSI fund absolute return has been quite good. Uh, as far as selection of the stock is concerned, see my focus has always been on growth, and you would find that we had looked at the growth, and we had looked at businesses which are at inflection point. So as I speak, I had overweight position in smaller NBFCs and HFCs. The thought process was simple. If India at some point of time would have a trade deal with US, and if that gets sorted out, I think the growth would come back for a lot of smaller HFCs, smaller NBFCs. Secondly, and I think the focus is towards growth because even the regulator has become pro growth. We have seen all incremental policies of the government of India as well as the regulators focusing towards growth. So as we speak, the fund is more focused towards growth oriented stock. Uh, Between PSU private, I think I don't differentiate them. I just look at them as a lender, and I think I'm still hopeful that private sector would do very well. They had been losing market share, but they will come back.
you're a purely bottom up investor. I mean, from a fund management, that's what it's comes out. So correct me if I'm wrong. So
No, perfectly right, Ram.
yeah,
Both for the sectoral fund as well as the value fund, we will
it's
look at
mostly a
bottom of story uh, much more than the macro story.
but normally when we start a session like this, we discuss a lot of macros. GDP is doing well and all other macro we didn't start this discussion. We've started it straight from the portfolio discussion. So but you did mention about the earnings growth coming
Correct.
back. Give us some color as to where the earnings growth, because that's the most awaited, like.
So,
Yeah,
when we look at macros, generally everyone speaks about macro budget session happen. See, all these are important from a near-term perspective. So, whether we are not showing any chart today, but we have a one presentation where we show India's decadal GDP growth.
yeah.
So, across time period, India has been growing. The nominal GDP has been growing at more than 10%, except for last year when it was 9.5%. So, despite everything happened geopolitically, I think India's growth story has been very much structural. So all this macro thing are near-term focus. The CAD, the current account deficit, the currency depreciation, these are all near-term impact. But the long-term story of India remains that earning growth remains stronger. Today, as I speak, we have seen 125 basis of repo rate cut. We are by the regulator, and that's why I feel equity is the only asset class which is available for investing and growth from here on. Last year, if you see the broader index, earning growth was between 7 to 8%, and that's why we see all the right ingredients are put in place. Regulator has been loosening in terms of reducing rates. Government has done a very fine balance between capex and consumption. So in the budget, if you see, the capex growth has been maintained at 8 to 10%. The assumption and everything there, government had done it for consumption. So last 15 years, when I said consolidation period, that is the time government become inward focus and has done everything to support consumption. The GST cut, the interest rate cut, the freebies distributed by the state government, all together when you add, they are very closer to what 11 lakh odd crore rupee of freebies given in terms of freebies or given the government. That will certainly support the consumption, and which is why I said staples could be a next contra idea or
Okay.
bet to play.
So, like in a cricket match, the pitch is nice, bright and sunny conditions, best batsmen are there, just runs have to come. Everything is in place for the economy, just the earnings growth has to come. Is what would that be a
I agree.
concluding message
So,
to this?
see, earnings growth would improve because the government has started become inward focus. And I think in terms of geopolitical, India signing a trade deal with EU, India signing a trade deal with US, is itself a sentimental positive. So we have seen unprecedented FII selling in a short period of time. Okay, even if FI doesn't become buyer, even if the selling stop itself would see the market getting re-rated. Second, more importantly, each and every sector would get benefit because of the trade deal, and you could see bottom-up earning in India will be improving. Whenever that happened, you see a rally in small cap, mid cap, and if you look from the valuation perspective also, large mid cap and small cap have corrected very meaningfully in last 12 to 15 months. Today we see pockets of valuation where we see pockets of comfort level coming in. We see pockets of where we can make money, where you can deploy a capital.
Sure. Thanks, Anand. Amazing it was discussing with you. You have covered an entire range of topics when it comes to equity investing, macros, and especially value investing. Thank you very much. Thank all the audience for joining in today. Thanks a lot.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.